So, you're thinking about investing in commercial real estate, right? But wow, where do you even begin? It can feel completely overwhelming. Well, today, we're going to slice right through all that noise. We're going to focus on just one, fundamental decision that really shapes everything else, the choice between two very different kinds of funds.
The best way to get your head around this is to think of it like you're picking your race. Are you a marathon runner? In it for the long, steady haul, looking for consistent income and the ability to access your cash? Or are you a sprinter, going all out for a powerful burst of growth and a huge prize at the finish line, even if it means you're locked in until the race is over?
All right, let's kick things off with the absolute basics. How are these funds actually built? And, more importantly, how do you get your money in? And, just as critical, how do you get it out? This one little structural detail is the foundation for, well, pretty much everything else we're going to talk about.
An open-end fund is kind of like a building with a revolving door. It's always raising money, and investors can typically come and go on a quarterly basis. It's flexible. A closed-end fund, though, is the total opposite. It's more like an exclusive expedition. It raises all its money in one fixed period, and then, boom, the gate is locked. Once you're in, you are committed for that entire journey, and we're often talking 7 to 12 years.
But even that revolving door has a kind of security feature. It's called a liquidity gate. Now, if the market gets shaky and way too many people rush for the exit at once, the fund manager can basically hit the brakes. They can limit withdrawals, often to about 5 or 10% of the fund's total value each quarter. This is actually a good thing. It protects the fund from being forced to sell off amazing properties at fire sale prices just to meet redemptions.
So we've got the structures down, but how does that actually translate into making money for you? Well, their entire investment playbooks are completely different, and that changes everything, from how the managers get paid to the kind of returns you can expect to see.
The strategies are truly night and day. The open-end fund, it acts like a landlord. Its main goal is to buy stable, high-quality buildings that are already mostly full of tenants. The whole point is just to collect that steady stream of rent checks. The closed-end fund, on the other hand, is more like a house flipper, just on a massive scale. It's out there looking for properties with potential. Ones that need to be fixed up, developed, or maybe need better tenants, all with the ultimate goal of selling them for a huge profit down the road.
And this strategic difference shows up right in the fees. Open-end funds charge a lower management fee for their steady oversight. Closed-end funds charge a bit more, but the real story is the performance fee. You might also hear this called carried interest. This is where managers take a pretty significant cut of the profits, which powerfully aligns their success directly with yours. They don't get the big payday unless you do.
You can see the ambition of each fund right here in the target returns. The steady, income-focused open-end fund is aiming for a really solid 6 to 10%. But the closed-end fund, it is absolutely swinging for the fences. It's targeting returns that can be more than double that. We're talking in the 12 to 25% range, and sometimes even higher than that.
But that incredible high-growth potential comes with a pretty famous catch. It's called the J-curve. For the first few years, your investment will likely show negative returns. I know, that sounds scary. But it's because you're paying fees while the fund is out buying and fixing up properties and it hasn't sold anything yet. The big payoff, that sharp upward spike on the curve, that only comes later in the fund's life. You gotta have patience. Of course, higher potential returns almost always come with higher risk. It's just the name of the game. So what are the biggest downsides, the biggest risks that you really need to be aware of for each of these paths?
For open-end funds, the biggest danger is something called a liquidity mismatch. Basically, the fund owns these illiquid assets, giant buildings you can't sell overnight, but it promises relatively liquid cash back to investors. If too many investors ask for their cash at once, it can cause a run on the fund. You could get stuck in a long line, a redemption queue, trying to get your money. And even worse, the manager might be forced to sell great properties at the absolute worst time just to raise that cash.
The risks for closed-end funds? They are all about that lock-in. First, you've got vintage year risk. What if the fund buys all its properties right at the peak of a market bubble? Ouch. Then there's manager risk. You're basically stuck with that manager for a decade, for better or for worse. And there's even extension risk. Sometimes the fund's life can be extended by a few years, which means your capital is trapped for even longer than you originally planned.
So after weighing all the strategies, the returns, and the risks, it really all comes down to you. Which one of these paths actually aligns with your own financial goals?
It really just boils down to a bit of self-assessment. If you need potential access to your cash, you want that steady income, and you prefer lower volatility, well then, the open-end fund is your marathon. But if you can truly lock up your capital for 7+ years,
You're chasing those much higher returns, and you can stomach that initial J-curve and the volatility. Then the closed-end fund is your sprint.
And just when you think you've got it figured out, the market innovates. A new breed of hybrid funds is popping up, and they try to offer the best of both worlds. You know, the liquidity of an open-end fund with the high-growth strategies of a closed-end one. Just be warned, when you try to do everything, you can sometimes inherit the risks of both worlds too.
And that brings us right back to our original question. Look, the goal for any investor is clear: generate returns. But in the world of commercial real estate funds, the path you take to get there matters immensely. So, looking at your own financial finish line, which race are you truly prepared to run? The marathon or the sprint?